You're ready to move. You found the perfect house in East Cobb or Town Lake, but there's one problem. All of your money is locked into a house that you're sitting on right now. And here's what most folks won't tell you. There's actually 8 different ways to solve this problem, and only really a few of them make financial sense for most people. The rest, they're pretty expensive. Convenience plays a factor in the cost, and you end up spending tens of thousands of dollars. I'm going to walk you through all 8, show you the real costs, and tell you which ones I actually recommend to my clients here in Cherokee and Cobb County. Because the truth is, buying before you sell is not impossible. It just requires you to know which levers to pull. Let's start with the cleanest option most people don't even know exists. Option number 1. This is the move that changes everything if you qualify. Here's how it works. If you have at least 5% down for your new purchase and can document a signed lease on your current home, we can remove or reduce the entire mortgage payment from your debt-to-income calculation. Sometimes it's only going to be reduced. Sometimes I'm going to be able to remove it altogether. Just depends on how it's structured. Are you collecting enough for rent? That means if your current mortgage is $2,500 a month and it's killing your ability to qualify for a new house, we can make it disappear from the equation altogether. But you need to have 3 specific documents in order to make it happen: an executed lease agreement, proof that you received the first month's rent, and proof that you have a security deposit that's actually been deposited. Once we have all those, potentially the full PITI payment, that's principal, interest, tax, insurance, and any HOA dues, can be offset. Now, here's where it gets interesting. This only works if your income is strong enough to qualify for the new home on its own. Of course, you still have to qualify for the new home you're purchasing. You're not carrying 2 mortgages in the calculation anymore, but you still need to show that you can afford the new payment. You can't utilize that rental income or as income. The risk, well, you become a landlord. Vacancy, maintenance calls at 10 p.m., property management fees potentially if you hire it out. That's real, and I can attest to that. But if you're in the area like Woodstock or Canton where rental demand is strong, this can be one of the smartest wealth building moves you make. You keep the current asset, you build equity on 2 properties, and solve the DTI problem without spending a dime on any sort of bridge loans or cash out refinance. This works best for buyers who are already thinking about keeping the property for long-term gains. Option number 2, HELOC on your departing residence. This is my personal favorite for people with strong credit and equity positions. You take out a home equity line of credit against your house you're selling, and you use those funds for the down payment on your new purchase. Why this works so well? Well, there's no seasoning. Typically, you need a 60-day seasoning requirement needs to be met. Because the funds are secured against the real estate, that's eliminated. You can pull the money out, close on your new home, and then pay off the home equity line when the current house sells. It's fast, it's flexible, it gives you control. Here's the bonus most people miss. If you put down less initially using the HELOC and then you receive the full proceeds when you sell the home, you can actually do a mortgage recast. That's when you make a large principal reduction. Your payment gets recalculated, but your term stays intact. So if you're 6 payments into a 30-year mortgage, you still have 354 months remaining, 354 more payments. You just dropped your payment for $500, $600 a month because it's recasting on the new principal balance. And the cost, it's negligible. Obviously, the home equity line has some fees, which are usually pretty minimal. And the interest, while the line is outstanding, of course, but that's going to be based off prime typically. But compared to a bridge loan at 10% or higher, or a cash out refinance that resets your rate, this is a clean option. It's best for homeowners with at least 20% equity, good credit, and confidence that their home will sell in 90 to 120 days. Option number 3, cash out refinances. This one's pretty straightforward, but it can be expensive. You replace your existing mortgage with a larger loan, pull out cash for a down payment on your new house. The advantage is that you get access to a large equity amount with a structured fixed payment. The downside, full refinance costs. Your rate resets on the departing home, and you're still carrying 2 mortgage payments unless you convert it to a rental. When your home sells, the cash out loan gets paid off and you move on. This works best when you're planning to keep the departing residence as a rental long term, or when the equity position is so strong that the numbers still make sense even with the costs. But here's the reality. In today's rate environment, most people are locked into a 3 or 4%, and they don't want to refinance to a 7%. I get that. So this option has fallen down my list for clients in North Fulton County and in Cherokee. Option number 4, traditional bridge loans. This is a short-term line secured by the departing residents. So some of the typical features you'll see, first of all, no monthly payments, which is great, but that interest accrues to the payoff and it gets paid off when the home sells. So it sounds great, right? But here's the catch. You're often required to close with your purchase loan with the same lender providing the bridge. The rates are higher, sometimes significantly higher, and the closing costs can be steep. This works best when you have a short-term gap and a high likelihood of a quick sale. If you're selling a home in a hot pocket like East Cobb or Town Lake and you know it's going to move in 30 or 45 days, a bridge loan can be a great option to get you to the finish line. But if there's any chance your home's going to sit for 90 or 120 days or more, those interest charges start to add up pretty quickly. Option number 5, guaranteed backup contract programs. Now, we're getting into the creative stuff. This is where an investor provides a legitimate contract on your departing residence. Why does that matter? Well, because it eliminates your departing mortgage from your debt-to-income calculation. You're not stuck carrying 2 mortgages in the eyes of the underwriter. You still are legitimately still paying 2 mortgages, but you have a contract in place. The borrower gets up to 180 days to sell the home on the open market. If it sells, fantastic. You keep the profits and pay the fee to the program. If it doesn't sell, the investor buys it at the agreed upon price. So there is definitely some inherent risk that's involved here. Important notes that I want you to pay attention to. This doesn't work with government loans like an FHA or VA loan, but it does work with conventional and jumbo loans. And yes, there's absolutely fees that are involved. But if you're stuck strictly on DTI and you're confident your home will sell, this can be the difference between getting the house you want and losing it to another buyer. So it's best for buyers who have strong equity, a marketable property, and just need to solve the qualification problem. Option number 6, cash offer and buy before you sell programs. These are the convenience products. An investor either buys your home up front or funds your purchase so you can close as a cash buyer. You can close in as little as 10 business days. You get to make a cash offer, which in a competitive market, which we are still in here in Cherokee County, can be the difference between winning and losing. But at what cost? Rates are often around 10%. You're paying origination fees, broker fees, and in many structures, your existing first mortgage is still being paid unless it's satisfied. There's no monthly payment, but interest is still accruing, and you must refinance into permanent financing once the home sells. These programs come in different flavors: cash off bridges, buy-side bridge, instant equity. In many cases, your departing home must already be under contract, and they'll go up to 90% of the loan to value on the departing residence. These are not cheap, but in a market where being a cash buyer wins the deal, they can make sense if the numbers work and the home you're buying is worth the premium. Again, in many markets across the country, we're not dealing with multiple offers. We're not needing to be cash buyers, but certainly in many, many pockets, including Metro Atlanta, being a cash buyer still pulls a lot of weight and can absolutely be the difference between you buying that house and looking for another one. Option number 7, instant equity, sell-side bridge. This is a first or second lien on your departing residence. Typical terms around 10% interest rate, 2% origination if it's a first lien, 2.5% if it's a second, plus broker fees. The requirement is that your departing residence must be under contract, and yes, you can use a guaranteed backup contract to satisfy that. Here's the key note most people miss. You must continue paying your mortgage unless it's paid off as part of the transaction. So you're not eliminating that payment, you're just accessing the liquidity that's tied up in the equity. This works best for high equity sellers who need liquidity but don't want a full refinance and reset their rate. It's a tool, and it's certainly not a solution for everyone. Option number 8, seller financed second mortgage. This is an option that almost nobody's talking about. It used to be pretty popular back in the day, and now it's coming back. And it's often the most cost effective if you can find the right scenario. So here's how it works. Let's say, for example, you're doing a 70% first mortgage. The seller carries 20% equity. So your CLTV is 90% in mortgages. And then you bring that 10% down as the borrower. Why is this attractive? You're often getting near market rates, lower fees, you avoid mortgage insurance, and the underwriting is much more flexible. The reality is you still have to qualify carrying all the debts, your existing mortgage, new first, and the seller paid second, so you do have to have strong income. But this works best when the seller owns the property free and clear, has significant equity, or is a baby boomer looking for passive income. Baby boomers could be something to tap into over this next wave as they're getting ready to sell. They've got a ton of equity. In many cases, they are mortgage free. I've seen this structure save buyers $15,000 to $25,000 compared to the bridge loan programs, and it gives the seller a steady income stream at a better return than what they'd get on a CD or a savings account. It requires the right situation. The seller has to agree, but when it works, it is absolutely clean and it's super advantageous. So how do we choose what's the best option? Here's how I walk my clients through this. First question, is your primary issue DTI or liquidity, debt to income, or do we need cash? If it's DTI, you're looking at a rental conversion or a guaranteed backup contract. If it's liquidity, you're going to look at a home equity line, a cash out refinance, or one of the bridge options. The second question, are you willing to become a landlord? If the answer is yes, rental conversion is the cleanest play. If no, you're looking at access to equity strategies. Third question, how much equity do you actually have? And that should be potentially the first question. If you're sitting on $150,000 or $200,000 in equity, a home equity line of credit or seller second can make sense. If you're tight on equity, you might need a bridge or a cash offer program. And then the fourth question, what's your risk tolerance? If you're conservative and want certainty, guaranteed backup contract or a cash offer program can give you that, but at a cost. If you're comfortable with a little uncertainty and you want to save some money, the home equity line of credit or the rental conversions are much better plays. And the fifth question, how fast will your home realistically sell in Cherokee, Cobb, North Fulton, Metro Atlanta, or anywhere else? If it's a 30-day sale, a short-term bridge makes sense. If it's going to take 90, 120 days, you need a strategy that doesn't bleed you dry with interest costs. Every solution falls into three buckets. Bucket one, eliminate the departing mortgage from your debt to income calculation. That's rental conversion and guaranteed backup contract. Bucket two, access your equity early. That's a home equity line, cash out, or a seller second. Bucket three, temporarily replace your equity with a high cost of capital. That's a bridge loan, cash offer program, the instant equity options we talked about. The cleanest options are rental conversion, home equity lines of credit, and seller finance second. The fastest but most expensive options are the cash offer programs and instant equity bridges. And here's the truth that most loan officers will not tell you. In today's softer appreciation environment, strategy means more than speed. Okay, I don't care if you can close a loan in 7 to 10 days. Fantastic, that's good. But if you're giving advice that's going to put somebody in a terrible equity position down the road, who cares how quickly you got it? We want to make certain our strategy makes the most sense. Paying $20,000 in a bridge loan costs Paying $20,000 in bridge loan costs to close 10 days faster just doesn't make sense if your home is going to sell in 45 days anyway. But if you're in a multiple offer situation and being a cash buyer is the only way to win a house, then yeah, it might be worth it. And there are absolutely multiple offers taking place. I'm dealing with one right this second, and this is February of 2026. So I get it across the country. Not every area in the country is as desirable as the Cherokee County area in North Metro Atlanta, but there's absolutely multiple offers that are being written on a regular basis, and you need to have a strong strategy to make it happen. The key is knowing your options, understanding the real costs, and building a strategy that fits your situation, not somebody else's, yours. If you're a buyer in North Metro Atlanta trying to figure out how to make this work, or if you're an agent with a client stuck in this situation, this is what we do every day. We build custom financing strategies that solve real problems without bleeding unnecessary costs. Do me a favor, drop a comment if you've used any of these strategies before, or if you have questions about a specific situation. And if you found this helpful, share it with an agent or a buyer who's stuck right now trying to figure out how they make their next move, because buying before you sell is not impossible. You just need to know which door you need to walk through. And when you walk through that door, it better be guaranteed.